Here we go. All right, happy Friday, everybody. So, feel free to jump in if you want, but there's also the chat box that you can message me, and I'll try to check it periodically. But just wanted to give the update for July from the June numbers. So, again, I'm on Market Monitor, so you can look here to get the same information. So if we look at dollar close volume, so look at this last month. So in June 2021, we closed $1.22 billion in real estate. So look at the highest before. So last year our high was, roughly July. That was the first month we crossed $1 billion, and now look, we've done it in March, April, May, June. I would imagine July we're going to do it. So we have had 4 consecutive months over $1 billion, and we've never closed anywhere close to 1.2. So that's a 52% jump from last June. Now, you can see last June was still 800, and you can see from May to June there was that big jump because we started to, unravel from the shutdown. So a lot of those closings that were delayed from May closed in June. But you can see the 50% jump from last year. Now, interestingly enough, if we go back in time, so I can go back further in time here. So look at this. I mean, for relative perspective, so 1.22, and this goes back to 2004. So look at the low. So the low was roughly, beginning of 2009. We were 112 million. We're about 11 times as much volume today than we were back in January of 2009. So that's pretty phenomenal. And look at that growth in here even, and then just the jump coming out of COVID. So, I mean, that's pretty remarkable jump, in a relatively, a decade doesn't seem like a long time, in the history of real estate, but to go up 11 times within the decade is pretty remarkable. And Sean's adding it's a jump of 350% from 2019. Yeah, I mean, if you look at some of the lows, we were doing, January 2019, we did $338 million in a month, or 339, and to be at 1.2 is remarkable. Now, if I get rid of the seasonality, so look at the seasonality, right? You can see it every year. And then this was kind of a little funky, obviously, because of COVID, and then it jumped out of it, and then we, seasonality back down in January and February, but then jumped right back out of it. So if you ever want to get rid of seasonality, just go back to rolling 12 months. So if we go back to rolling 12 months, what comes up is more kind of, here's your annual number. So on an annual basis, right now, the past 12 months, we're almost at the pace of $1 billion a month. Not quite, that'd have to be, 12 billion, but we're almost at the pace of 12 billion. Now, within a few months, are we going to be there? Yeah, probably so. I think we add a couple more months and drop these off there, we're going to be at $1 billion. So compared to the previous 12 months, that's a 64% increase. So if we take the 12 months prior, that's 64% higher. And you can see, how dramatically that has changed. But you can also look on an annual basis. Look back in July of 2009, we were about 2 billion. So, here pretty soon we're going to be 6 times the level of closed volume as we were in July of 2009. And if I could go back to about 2002 or 3, we were about 2 billion. So we went from 2 billion to 6 billion almost, back down to 2 billion, a rise over all these years, and kind of flat in here, right? 18, 19, and these years were kind of flat and then just exploded out of it. So, obviously agent count is a mix of how much volume you're doing. As the volume goes up, agent count goes up. As volume goes down, agent count goes down. And look at this rise right here. So, you've got a dynamic of there's more. If you're doing $11.36 billion in sales, there's a lot of commission to be shared. Sean had a question. Can you next compare this to closed sales number? Yeah. So can you next compare this to closed sales? So from the dollar volume, so that's what's happened in the market. So let's go back to sales price. So we'll start going down the list here. So sales price, and again, this is the entire MLS. So sales price of median's up 14.8%. Now let's get rid of the annual. So here's the monthly. So monthly, we're up 22.8%. Now let's zoom in. Let's get rid of all these old years here. If we zoom in, look what's happening now. So 22.8% jump from, now keep in mind, it's from June of 2020. So when you look at it a monthly, it's June of 2020 compared to June of 2021. So 22.8% is huge. Now, if we do some quick math, so look what happened here. So June of 2020 to July of 2020 was a 6% increase. So 287,800 to 305, that's a 6% increase. So I just want to watch what's, to be able to forecast what's going to happen is what's going to happen when the July numbers close. So when July closes out, unless we do more than a 6% gain from June to July, this number will actually go down because of what happened in July of 2020, we're at 305. So if we look at 353, to get a 6% jump, we'd have to be at 374. There's no way we're going to be at 374,000 next month. That's just not possible. So last month we were at 349. This month we're at 353. So we are not going to experience a higher number than this in my mind, because once we started coming out, the numbers started to grow. Look, we went from 287 to 305 to 315. We're not going to keep up that pace this year. So you're going to watch this number drop. And what's going to happen in the media is all of a sudden that's going to start to slow down on a national level too. It's going to start to slow down what that increase is. But it's because you can't compare it to what was the shutdown period down here and not have a big number. So once we come out in a normal market, this is going to start to slow down. Price per square foot, the same thing. 19% jump, but once we got towards the end of the year, it was going up. So this is going to have a hard time to be higher than this as well. A percent of original list price here. So we are still eclipsing 100%. Whatever we're at, I don't know exactly, but we are still eclipsing 100% at this point. I mean, are we at 101, 102? I wish I could tell you an exact answer, but I mean, we're definitely over 100 for a period of time. Days on market. So days on market, we're down to 3 still. So we've been at 3, and keep in mind, compared to last year, I mean, we were at 34 in February, 24 in March. So this is obviously as low as we're probably going to go. And keep in mind, when they talk about median days on market, that means if a house is listed less than 3 days, half the houses are selling in 3 days or less, and half are taking more than 3 days. So, that's what the median means on here. Average is different. I like to talk about the median. So if you're one of the half that's taking a lot longer than 3 days, the market's telling you you're overpriced. Months of supply. So when we look at months of supply, we're down to 0.8, which we've been kind of sitting around that for a few months now. I'm not sure that's going to go much lower either. Homes for sale is very interesting. So we're at 1,607 now, of course, compared to June of last year. We had 4,686 in June of last year. Now, I do want to take a second to talk about this inventory. So we are at, when I checked this morning, we're at 1,735. So our active count is 1,735. Now, this was an end of June number. We hit a low in May. The middle of May, we were at 1,289. So we are coming out of this bottoming process, and we're 60 days out of it. So if I look at 1,735, we were at 1,735 in February of this year. So we have absolutely formed a bottom on inventory, and we are slowly coming back up out of it. Now, to have a decent amount of inventory, we need to be back up in this range here. How long it takes to get there, we got a couple of years in my mind. But just be wary that the inventory is increasing, and traditionally when that trend changes, it doesn't all of a sudden change back. It's going to be a upward movement. If I look back, let's go back in time, and again, let's get rid of seasonality. This is traditionally like a long-term trend up or down. It's not a zigzag up, down, up, down. You can see we fell off coming out of, even pre-COVID, we had started to drift downward, and then we just started falling pretty dramatically. So I expect us to return to this level in here, right around 6,000 houses for sale. How long it takes us to get there? I don't know, 2023, 2024. It's going to take a little while to build that back up, but it is starting to increase and head that direction. So that is a number that I watch every morning. It's like, what's the count in the morning? Because that gives me better direction on where the market's headed. Closed sales, and let's zoom in a little bit here. So closed sales, we did 2,458 in MLS, keep in mind, what's closed in MLS, which was a 19% increase. And we actually topped, we topped from a year ago, last July, we were 2,435. So this June beat last July's high. So last month was a record month for closings, number of closings in Charleston. So, how long we can keep this pace up without much inventory? Obviously, we're having a lot of sales happen off the market, and then agents are entering them in MLS. But it's going to be hard to keep up 2,500 sales a month without getting some more houses on the market. There's still that buyer demand out there. And if we look back, if we go back in time, and we look here, so as we go back in time, trying to make 2,000 at the pre-recession peak, and then post-recession, at the bottom of the market, we were trying to make 1,000 sales. Now we're at 2,500, and then you can see in here, we started hitting about 2,000 sales a month, and then obviously coming out of this, we're getting close to having months where we're doing 2,500 sales a month. So now if we do an annual basis, so if you do the rolling 12 months, so on an annual basis, look at that. So the past 12 months, we've almost done 25,000 sales in the past 12 months. Now, for perspective for everybody, we were at 7,700 back in 2009 at a lower price point, right? So, we're doing 3 times the number of sales we did, 11 years ago. Let's zoom back in the past 3 years. So if I look at recently, the past 3 years, so here's the new listing count too. So on new listings, we're hitting 2,500 new listings last month, which is not out of the ordinary, right? If we didn't know what happened with COVID, it doesn't look much different, right? We're still, part of what's happening is you have a lot of listings that are entered after the fact. They hit MLS and they're already under contract. They hit MLS, they're already closed. So, but we are hitting about 2,500 now. Can we do much more than that? I don't know. I think this is kind of showing us this is matching out what the market is doing. It does not look very dissimilar when you look at new listings. And even back in 2016, we were listing 2,500. Now we're listing them a little bit later in the year, because traditionally, if you look at the peak listing month, in here it was March. This year it was March. If we go to, let's see here, this was March in 2018. Roughly March and May was the high here, but you can see it's usually a spring, and keep in mind 2020 was all out of whack, but it's usually more of a spring, so we're a little delayed in listings this year. But we're hitting about 2,500. If we look at pending sales, so look at the pending sales. So we have 2,274. Now what's interesting is look at this. So we're actually down on pending sales compared to June of last year. So June of last year, we had 2,299. June of this year, we had 2,274. So we're actually lower. Last July, we had 2,354. I don't know. We could be down even more next month when we look at the numbers. So the pending sales seem to be capping out on here. And the pending sales obviously jumped from here. We weren't even hitting 2,000 pending sales. So that was a significant increase, but I think we're kind of maxing out on what we're doing. And then as we talked about earlier, that dollar volume is quite phenomenal, that we're doing this much volume of business. And a lot of it has to do with those higher price point properties are moving now. Back in here, it was still a challenge to sell $1 million plus house, and now they're moving, they're selling. So this is really kind of ramping up that dollar volume. If you look at shows depending, so we're about 13 showings to go under contract on average. Now, those 13 showings on some houses take place in a day, right? Some place might take a couple weeks, but you know I usually kind of use the 10 to 12 count. If you've had 10 to 12 showings and you don't have an offer, that's also a sign the market's saying you're overpriced. So, you know, this is kind of a good gauge for how many showings before you get an offer. And again, in 2021, these might all happen on the first day. Shows per listing. So it's interesting, the last couple months, it's been dropping. And I've been trying to figure out why. You know, we obviously jumped up out of that, and now we're starting to drop down. So, you know, does that mean we're just, because remember, our inventory is higher, right? So it's trying to read what's that doing to the buyer count. Since the inventory's up, you're spreading the same number of buyers maybe over more houses to look at. And I want to put in perspective, if we go back to what the homes for sale. So May 18th, we had 1,289 homes for sale. So that was the low day. Today we had 1,735 this morning. We're probably higher right now. That's a 34% increase since the middle of May. So in roughly a 50-day window, our inventory has grown by 34%. Now, it's still really low, but that's a pretty significant move in less than 60 days. And I just want to put it in perspective for people is that, okay, if you had a buyer in the middle of May and you could show them 3 houses that met their criteria, that means today you could show them 4. Well, does that mean like by the end of the year, we're showing them 6 that they could look at 3 in May? So they, you know, sometime probably later this year, they might have twice as many selections as they had, you know, maybe next year. They might have twice as many selections. So the buyers are going to become more picky because it's like, look at my choices, and this one has granite, this one does, you know, they're going to become a lot more picky. But when there's 1,289 for sale, they're buying it because it's available. So it's something to watch for very, very closely.
Anton?
Yes?
I'm guessing that the shows per listing went down just because things are going under contract so quickly, and including the off market like that.
I mean, and that certainly could be part of it. Is that, I mean, I listed one in Park West yesterday, and I could have had showings all weekend, but when you get a cash, clean, over full price offer, the seller was like, "Hey, I'm good with this. We can just shut down the showing."
And I'm guessing the off market deals drag it down too, right?
Yep. No, off-market deals, it's basically zero is what shows up because nothing's rolling through showing time. So keep in mind, this stat and this stat are both showing time information fed through the market monitor. Now, I thought it would be good to show everybody, if we look at, I'm going to switch over and I'm going to go down to a specific area. So remember, that's Charleston as a whole. But if I dive down and look at a specific area, so what I'm going to do now, so here's downtown. So we'll take inside the crosstown. So if I just click on inside the crosstown, look at this now. So median sales price. What's the median sales price? 1.7%. What was Charleston as a whole? 22.8. Is that different? Yeah, that's significantly different. So it's kind of remarkable that you can dive down to a specific area and how flat this looks, right? So it's a very flat market, you know, from a median price standpoint. So downtown looks completely different than Charleston as a whole. Look at price per square foot, very flat, right? Doesn't look like Charleston as a whole. Percentage of original list price. Now, the last couple months, you know, very flat, right? We had this drop here, which was interesting. You know, we dropped down to 86% in January 2020, pre-COVID, right? This is nothing to do with COVID. So pre-COVID, we're 86%. So think about that for a second. Downtown properties were negotiating on average, as a median, 13.3%. So that means over half the listings were negotiating more than 13% off of the original list price, right? So was that a combination of agents outpricing the market to get from the beginning and having to drop? That's a combination of buyers negotiating more because there's more inventory for sale. But isn't it remarkable how different this looks than the Charleston market? Now, the last couple months, we're back up to 97.2%. Whether we get to 100 downtown, I don't know. maybe not, but it looks different. So if you're dealing with a property downtown, make sure that your conversation is based off of this information, because it is a slightly different market. Look at days on market. What are we at? We're at 28. Does this look anything different? It's about flat, right? There's not much change over the history of the days on market. So now we've kind of, since the beginning of the year, this is a pretty strong trend downward. We'll see if this continues this way or if we jump back up. But 28 is not 3 like the market as a whole either. So half the houses are selling within a month and half are taking a month or longer. Months of supply, what we're at in Charleston, we were at 0.8 months. Here we're at 3.8. So for perspective, that's almost 4.5, 5 times as slow downtown than the rest of the market. Now, big drop from 14.4, right? So that's a massive improvement to go from 14.4 to 3.8, right? So we went from a pretty strong buyer's market to let's say a pretty strong seller's market, not like Charleston as a whole, but we flipped in a year from a buyer's market to a seller's market downtown. So that's a pretty remarkable change, of what happened. And then, just for perspective, if we go back in time, look in the recession, we had 54 months of inventory downtown, 54. We have 3.8 now. So I'm going to put, nobody who was in the business back here, for perspective, if you had 54 listings downtown, one was going to sell that month. That's what it meant. So you had 53 sellers who failed to sell that month, one that did. So you, as a buyer, do you think you had leverage? I mean, you were one of the only buyers out there. So for perspective, to go from 54 and now we're back down to under 4 is pretty remarkable for that to happen. Homes for sale, again, it's dropped pretty significantly downtown. So now we're down to 217. So that's part of what's driving the monthly supply down, is the inventories come down. Closed sales, we're hitting over 80 a month, double of last year. So the sales doubled from last year. New listings, pretty flat, so no significant change here. Pending sales, it jumped up. It's kind of leveled off again. We'll see what happens the next couple months. Dollar volume, again, some higher priced properties are selling now. So you're seeing the same trend down there where you're having some high priced closings kind of adjusting these numbers. Shows depending, 18, so more than the market as a whole. And then shows per listing, we're about 6, so not as many. So isn't it interesting if you look at a specific area, how dramatically different it can look? And I wanted to show you maybe another extreme. So let's go look at Daniel Island. So here's Daniel Island. Look at that rocket up of 51% increase in median sales price. 51. What was the market as a whole? 22.8. 51% on Daniel Island. Now, you got to keep in mind, not every house went up 51% value. What it means is half the houses that are selling are more than 1.285. So that high-end market has returned with a vengeance on Daniel Island. Right? That's what it means, that high-end market is moving. So median price up 50%, price per square foot up 42%, percentage of original list price, now they're over 100%. We don't know how much. Days on market, 2. So pretty much you just put it on the market and it sells. Months of supply, 0.6. So Daniel Island is faster than the market as a whole. Homes for sale, 28. So think about all of Daniel Island, there's 28 condos, townhomes, homes, there's 28 total for sale. So remarkably low. Closed sales. So interestingly enough, closed sales are kind of level, right? Coming out of COVID, it's been fairly flat. Now higher level than back here in 18 and 19, but 53 closed sales. New listings, only 44, so we're having a hard time getting enough properties on the market. Pending sales, dropping off a little bit again because there's just not enough for sale. The dollar volume jumped up. especially coming out of COVID. So you can kind of see, what the Daniel Island market is doing. If we go back and let's go look at inside the connector in Mount Pleasant. So if we look at inside the connector in Mount Pleasant, 34%, almost 35% on median price. What was the market? 22.8. So that's telling me inside the connector is a even hotter market than the Charleston market as a whole. Price per square foot jumped up 22.9, over 100%. Days on market 2. I just looked one this morning, so hopefully I'm keeping up those numbers. But months of supply, we got down to 0.5 months, 0.6 months. So, you have half a month of inventory, which, again, I want to put in perspective to everybody. In the recession, we were 20 months. So, again, months of supply, the rule is if you didn't list another house, how many months would it take to deplete your inventory? So it was 20 months here. Here it's basically in 2 weeks, you're out of houses for sale. The way I like to look at it is really is like, okay, if you have 20 signs and yards inside the connector back here, one was going to sell. If you have a sign, it's going to sell this month right now. We obviously don't have enough supply. Homes for sale. Let me zoom in a little bit. So homes for sale, we're sitting about 70, 80, but I think we're bottoming out here. I think we will drift up over time like the market as a whole. Closed sales. So we're up 30% on the number of closed sales, but we're not topping last year's top, so to speak. We seem to be capping out at that's what it's going to sell, 150, 160 a month, and that's the most that we're going to be able to do. New listings, kind of flat, doesn't look very different than any other year. Pending sales, again, we ratcheted it up coming out of COVID, but we're not setting any new records right now. Dollar volume, again, we're peaking out because we have some of these high-end sales that are happening. Last month and this month, there's 2 months that we're, selling $120 million inside the connector. Shows the pending. Now, interestingly enough, we had 18. Now, is that with the 2 days on the market? That is a lot of people jamming through houses really quickly, right? Because this number of showings per listing is above the market average, but the month of inventory is below. So it's showing me we're shoving a lot of people in these houses, very quickly. And then 14 shows the pending. Again, the same sign of there's a lot of people jumping on showings very quickly. From the bigger perspective picture is that watch that 10-year Treasury yield. It was going up earlier this year, and all of a sudden the last 60 days it's been going back down. So the 10-year Treasury yield is always the kind of market guideline for what interest rates are doing. And, when the Treasury yield was up to about 1.75, 1.8, everybody's like, oh, rates are going to be going higher. And now all of a sudden it's turned around and gone back down 0.5%. And everything I read, I don't think anybody really understands why. There's a lot of dynamics in the world happening right now. But those yields going back down is telling me interest rates are probably here for a while where they're at. Until that starts showing signs of coming back up, people can get mortgages in the low 3s. And historically, it's still a phenomenal rate. And unless rates start to jump, the buyers are still going to find the affordability. What are rental rates doing right now? They're through the roof, right? So it's still an affordability equation for buyers. If it's still cheaper to buy because of price and interest rates, they're going to buy. If it's cheaper to rent the same house, they're going to rent. And the rent rates jumped up enough, the interest rates are low enough that I still think we're in this market of appreciation because of the fact that it's still more affordable to buy a house than to rent a house. And so I think these rates are here at least for, a while longer. I'm not saying buyers need to wait until it goes up, but the rates being low is still going to help sellers get their houses sold, and it's also going to help buyers have an affordable payment. Every time we talk about inflation, well, what's the one thing that you can have that you can fix for 30 years on a price? It's your mortgage payment, right? What else can you fix for 30 years on price? your doctor visits, going to Walmart, none of that stuff, right? Your house is the one thing you can fix for 30 years. So that's the one thing on an inflationary period. If you can get a house that you can stay in for a longer period of time, you can control as an individual yourself your outgoing expenses. So I think what's happening right now is people are getting to where they want to go and getting these long-term low interest rates. And as time goes on, if rates go up, well, they still can have a fixed mortgage payment, right? So it's putting themselves in a position that that's one of your biggest payment. It is your biggest payment traditionally, is your mortgage payment. So 30% roughly of your expenses is a fixed expense. So it can combat an inflationary, period if you're a homeowner. Whereas rental rates, how do you control rental rates if you're a tenant? It's hard to, right? You're at the mercy of the market. If you sign a 1-year lease, you're at the mercy of what the rental rates are a year from now. So it's hard as a tenant to control. That's why buying a home is so desirable. And we're hitting a higher number of home ownership. I mean, we're probably at 66, 67%. I haven't looked lately, but probably 2/3 of people in the U.S. own their home. But that's, it traditionally does not go above 70%, because as that goes up, then the rental rates start to come down and people would rather. So it's all these dynamics that it's hard to move that needle much above where it's at right now. But all the dynamics of what's going to happen. I mean, how do we have 9 million job openings and 9 million people unemployed is kind of boggling my mind. You have a high in unemployment and a high in job openings all at the same time. I mean, when you're driving around town, how many now hiring signs do you see, or help wanted? You see a lot, right? Look around. When you're going out, you see a lot of help wanted signs, but the unemployment is still really high. So there's a lot of dynamics happening in the background that, it's going to take us where it takes us, but we're still not past this adjustment coming out of how the world has changed, because you can't have that many people unemployed and that many job openings and think that everything is in a stable, business environment. Because if employees can't get enough, if employers can't get enough employees, what do they have to do? They have to raise their wages, right, to attract somebody. So that's an inflationary pressure, because when they raise wages, what happens to them? Then the products are more expensive. So we're in this environment that we'll have to watch what happens with inflation, but the one protection against that is owning a house. And honestly, if you have an investment property, well, what do rental rates do? Over time, they're going to go up. What's your mortgage payment going to do? If you're an investor who has a 30-year fix, it's going to stay put, right? So it's a great conversation to have with potential investors too, is that it's the one thing to combat inflation is get a 30-year fixed mortgage. So anyway, that's what most of what I had to talk about today. Does anybody have anything to add or any questions? And again, I encourage you, look at that inventory and watch what's happening, because it is going up. And every morning, check out what that number's at, and you're going to see this market start to change as that number goes higher. And just be prepared and having conversations with your sellers, not getting ahead of the market. As that inventory goes up, they have more competition. And if the buyer count starts to slip, then you have less, demand. So things can change fairly quickly. And I do see some houses being overpriced because you see them sitting. And people are getting ahead of themselves. And I'm not saying that there's not multiple offers on a ton of properties right now. There are. And I feel bad for buyers, but over time, you have to look at it on a daily basis to be ready for when that, to watch what happens when it changes. So, well, thanks for everybody's time today.
Anton,
be safe this weekend. Yes?
You may have said this if I wasn't listening fully, but on the percent of original price, we can get that on specific markets.
Yeah, I think you can go into MLS and get that on a specific market.
Oh, in-market monitor. In-market monitor. So if you wanted to do it for area 42 or a subdivision.
Right, I'm on 42 here. right? And then it's still
Wait,
over
no.
100%.
Well, take it on, okay, do a subdivision or do Daniel Island. Is Daniel Island going over? I've seen
Yeah,
it
it's over.
numerous times on like specific areas and or subdivisions where it's showing the percent over 100.
Huh. I've
'Cause
not
when
seen, I've never seen it
Because
over
when
100, so I don't,
this is what I had asked MLS about like a few months ago,
Yep.
and that was their feedback to me. And indeed, I've
oh,
just
there it is.
yeah.
Devil's Island.
So I just want everyone to know that you can do that. Yeah.
But, you know, it's not correct everywhere, because I guarantee you Daniel Island's over 100% in some of these other areas, and it's not reflecting everywhere. Johns Island reflects it, but not everywhere.
Yeah.
So,
yeah. Anyway, it's better than not doing it. So
yeah.
if you can. I mean, so, and then the other thing I wanted to ask is, do you have any information on, because I've now heard conflicting stories on the millennials, how many years they're going to be entering their peak buying year, like that tranche?
Yep.
Because I've heard the wave is, sorry, go ahead.
I haven't read specifically like what the time window is to expect, but I mean, I imagine we're in this 10 to 15 year window where the millennials are going to be in their peak, you know, home purchase, you know, window.
I've heard 5-6 years, and then but then an Inman article referred to that this is the peak right now, which I was very surprised by.
Yeah, I think I'd be surprised if it's right now. And again, there are so many dynamics that go into the number of transactions that, you know, as agents, I think the one thing that on a transaction count that would concern me is the fact that these low interest rates and these home purchases, I think people are going to start seeing their houses longer. You know, especially if rates go up, they're not going to leave their rate. So that can affect our transaction count, which then affects our volume as a total. So it's just something, you know, that's why I like to do this every month, is that we're going to see this coming and see the trend. And
that's not being written about so much, that the people stay, at least that I've seen.
Yeah, I think we're going to expand the longevity of, you know, people owning their home. I mean, my parents have been in their home since 1976, and that doesn't happen anymore. And I'm not saying somebody's going to be in their house for 45 years, but they're going to be in it for 7 to 10 instead of 3 to 5. So,
big difference.
Well, everybody have a great weekend.
Thank you very much.
And I'll talk to everybody in the office or the first Friday of next month. So,
thank you, Anton.
All right, that's it. Thanks. Bye.
Thank you.
Bye.